To start a bank, regulators typically want to see at least $20 million sitting in reserve before you're allowed to open a single account. To build one floating vessel that processes and stores oil pulled from the ocean floor, the kind used on major offshore projects, the price tag can run anywhere from $200 million to well over $4 billion. Both of those businesses have to convince someone, a bank, a group of investors, an entire syndicate of oil majors to hand over that money before they've earned a single dollar of revenue. There's another business that needs almost as much capital to operate at real scale, but it doesn't ask a bank for it. It doesn't pitch a room full of investors. It asks you years, sometimes decades before you will ever actually use what you're paying for. That business is the cemetery. And the mechanism that makes it work has a name: pre-need. Here's the idea in its simplest form. Instead of waiting for a family to walk in, grieving on the worst day of their life, and pay full retail price for a plot, a casket, and a service, the cemetery sells that exact same package decades in advance at today's price. You might be 45 years old, perfectly healthy, nowhere near needing any of it, but you sign a contract now, lock in the cost, and pay it off over time the same way you'd finance a car. Multiply that by a few hundred contracts a year, every single year, and you've built something that looks less like a graveyard and more like a life insurance company that happens to also own the land. There are two ways this money actually gets handled, and the difference matters a lot to how the business makes money. In many states, the cemetery is legally required to place a portion of what you pay, in some states as much as half, plus an additional slice once the contract is fully paid off, into a trust. That trust is often pooled together with hundreds of other cemeteries under a single state funeral association, managed by a professional trustee, and invested under what's called a prudent investor standard, which gives it more room to actually grow than a basic savings account would. The other method is pre-need insurance. Instead of a trust, you're sold a life insurance policy with the cemetery or funeral home, listed as the direct beneficiary. When you die, the policy pays out straight to them, covering the contracted cost. This is actually the more common structure across the industry, largely because it hands the seller a commission the moment the contract is signed instead of years later. The trade-off, according to people who manage these portfolios professionally, is that insurance-backed plans tend to generate meaningfully less long-term profit for the cemetery than a trust does, because the investment growth sits with the insurance company, not with the cemetery's own fund. Either way, notice what actually just happened. The cemetery received a chunk of cash today for a service it might not deliver for 30 or 40 years. It didn't take out a loan. It didn't sell equity to a venture investor. It didn't get examined for a capital ratio the way a brand new bank would. A customer quietly planning for their own mortality simply handed over growth capital voluntarily, decades ahead of schedule. This is the same basic principle behind one of the most famous investment strategies in modern finance. Warren Buffett has talked for decades about insurance float, the pool of premium money an insurer holds in the gap between the day it's collected and the day a claim actually gets paid. That money doesn't belong to the insurer, but the insurer gets to invest it in the meantime. A cemetery running a large pre-need book is sitting on its own version of that exact float, except with an even longer runway, because most people buying a pre-need contract are buying it decades before they'll need it, not months. The largest player running this exact playbook isn't a small local operator. It's Service Corporation International, the biggest funeral, cremation, and cemetery company in North America, serving more than 600,000 families a year across nearly 2,000 locations in 44 states. Back in 2017, Service Corporation International signed a 10-year partnership with Global Atlantic Financial Group specifically to become its preferred pre-need insurance provider, a deal built entirely around scaling the exact mechanism we just walked through across an enormous customer base. Now, here's the part that keeps this from being a free lunch. When a cemetery sells a pre-need contract, it's typically promising to guarantee the cost of the goods and services, no matter how much prices rise in the meantime. And funeral costs have not been rising gently. Over the past several years, the average cost of a traditional funeral has climbed somewhere around 4 to 6% a year, consistently outpacing general consumer inflation. Cemetery plots, specifically in land scarce urban markets, have in some cases climbed 10 to 15% in a single year. That means the company is making a real bet that the trust or the insurance policy backing your contract will grow faster than the actual cost of caskets, labor, and land appreciates over the coming decades. If funeral cost inflation outpaces the investment return sitting in that trust, the cemetery eats the difference out of its own pocket on a contract it signed decades earlier at a price that no longer resembles reality. That's the real risk sitting underneath this entire model. And it's exactly why state regulators police minimum trust deposit percentages so aggressively. They've seen what happens when a provider underfunds these trusts for years and then can't actually deliver on decades old promises. There's one more shift worth knowing about because it's quietly reshaping this whole industry from underneath. More than half of all funerals in the US are now cremations rather than traditional burials, and that share is climbing fast, with some projections putting it past 80% within the next 2 decades. That doesn't kill the pre-need model. Cemeteries sell pre-need cremation niches and memorial packages just as aggressively as burial plots. But it does mean the product mix funding all of this is shifting under the industry's feet, even as the core financial engine, getting paid decades before delivering anything, stays exactly the same. So put the three businesses side by side one more time. A bank needs $20 million from investors before it's even allowed to open, and spends years afterward under heavy regulatory supervision to protect depositors. A floating oil production vessel needs, in some cases, billions from oil majors and lenders before it processes a single barrel. A cemetery running a pre-need program gets its growth capital handed over voluntarily, in installments, by the same customers it will eventually serve. Sometimes 40 years before the service is ever delivered. It's one of the quietest, strangest capital structures in business. Buying a burial plot at 45 doesn't feel like funding a company's expansion. It feels like planning ahead. But financially, it's closer to what happens when you buy a life insurance policy or hand your money to a bank in the form of a deposit. Nobody thinks of a cemetery as a financial engine, but that is exactly what it is.